Yep.
I think so.
You want to retweet from Ethan?
Yeah, I can. Or which one do you got?
Or I can do it.
I'll do decontrol. You do Ethan.
Well, decontrol posts.
Right.
It gets that already.
Yeah, if you've got it on your phone, I don't have
it on my phone, but
Christian. I'll see if I can get to it in a bit.
Yeah.
I don't think I can here, but all right. Thanks everybody for coming out to Decontrol here. Ethan at Decontrol on Thursdays. Pardon me, I'm kind of losing my voice. That's what happens after I go away for a little while and I talk my face off at conferences or events and stuff. So bear with me. We've got a bunch of things going on here. So every Monday we have like a poetry night thing. So if you're interested in like open mic poetry, you want to like talk about some magical things, you can do that on Mondays. And then every other Tuesday, so I think next Tuesday, we're not sure, but probably next Tuesday.
Yep.
Andrew and you guys, you're kind of involved.
I won't be there, but Andrew will.
Andrew is kind of leading it mostly.
Yep.
There's like an open jam night, so if you want to like play an instrument, you want to do something groovy with sound of some type.
Drum kit.
Okay.
Keyboards. We've got
keyboards. It might be more structured. I don't know. I've never been.
No,
so I'm just kind of talking out of my ass here, but there is some sort of musical event thing taking place on Tuesday. Drills to Queen songs. Okay.
No.
Well,
Just
regardless, if this
play
has piqued your interest in any way, shape, or form, show up on Tuesday at 6 p.m.
I think it's usually like
5?
6. Yeah, so 6 to 7.
6 or 7. I don't know. Just ping somebody in the Discord or get a hold of somebody or find Andrew. But anyways, that's what's happening on there. Mondays and Tuesdays. Obviously here we're Thursday. However, next Thursday is a kind of a special day. Does anybody know what next Thursday is? What day that actually indicate, like why that day is special? Quick. Oh, take a mic. Tell us.
Today, isn't it?
Bitcoin Pizza Day, yes. And so why is Bitcoin Pizza Day significant?
It's the first time someone bought something real with Bitcoin.
There we go. Well, I don't know if it was the first time. Was it the first time?
Yeah, I think so.
Was it the first?
I think it was like the first time it was like a
first
real
physical
world
transaction.
That was the first physical transaction. Okay, so it was like 26,000 Bitcoin or something. If that sounds, does that sound right?
I think it was 26 or 24,000 or something.
Yeah, something like just a quick 20 some odd thousand Bitcoin, and he got 2 pizzas out of it. What a beautiful thing.
Yeah.
Could you imagine? Like I would, what a deal. What a deal. So anyways, we are going to be celebrating that, and we celebrate that every year. Now, there's obviously some Bitcoin side of it where people like to go buy pizza with Bitcoin and like to express themselves that way. There is one of these other groups called Pizza DAO, and they basically have been doing this for 6 years now, 5, 6.
I think it's 5th annual.
5th annual. So this is the 5th annual Pizza DAO day where they basically just like have a worldwide global pizza party.
Yeah.
And so we've got an activation happening here in Vancouver, and it's going to be held. We were going to do it here, but we've got it at the Dapper Labs office. So over at Emily Carr, and that'll be from 6 to 9. Head over there. We'll get you some details and whatnot. We were trying to have the Luma ready for tonight, so we can share that with everybody. But so get ready to hop over there for some pizza.
Free pizza.
You just have to show up, and then you got to eat the pizza. And then there's going to be some drinks. And
pizza
some
songs.
Pizza songs, that's right. That's a very good point. Mm-hmm. So if you're into those sorts of things, if you like pizza, show up. And we're going to try and do some like gluten-free and dairy-free things as well. So I don't know if that applies to anybody here, but definitely does for me. You'll appreciate me a lot more if I have those types of things instead of just the regular. All right, too much information. Okay, see you guys all next week for that. With no further ado, let's just get Owen to dive into it here.
Yeah,
Thanks a lot.
Yeah, thank you, Tangle. I'm just going to start by saying there's a couple mics around. For any questions, please use the mics because we are streaming. It helps when other people are watching. If not, can't really understand what's going on. But yeah, I am talking this week. I thought I would do something on quant trading. It's something I've been like looking into a lot recently and kind of playing around with. But it's also something that's kind of very hazy in a lot of people's minds. So I kind of wanted to explain some of the basics and help you get an understanding of what is quant trading. Maybe you are interested in it, maybe you want to pursue it. Just kind of want to give that kind of basis that we can take a look at. So let's get into it. So what is quantitative trading? Quantitative trading is the use of rigorous math and statistics to identify profitable trades in financial markets. Quant trading revolutionized financial markets in the late 20th century, and it is the basis for high-frequency trading, market making, arbitrage, and other trading strategies. So it's essentially, rather than like, you can think of it as directional trading. Oh, I think this is going to go up. I'm going to buy this. Boom. Quant trading is a lot more behind it. You're kind of using mathematical models, maybe, or more information to kind of guide your trading. And make smarter trades, yes, you can kind of say. So I'll go through a few things. I'll go through the history first, kind of some big figures in quantitative trading, and then talk about arbitrage, order books, market making, crypto, and other. First, we'll go into history. The kind of the grandfather of quantitative trading, a lot of people call him, is Edward Thorpe. He wrote the famous book, Beat the Dealer, on how to win blackjack with probability and card counting. A lot of people in this realm are also very, they love gambling. And kind of the biggest gambling place is Wall Street, right? So a lot of these people kind of started out in casinos, making some money. And Edward Thorpe wrote a very famous book called Beat the Dealer. He also devised a pricing formula for options long before the popular Black-Scholes model. Kind of a fancy model, but yeah. He also co-founded Princeton Newport Partners in 1969, which achieved an annualized rate of return of about 20% after fees for over 2 decades. So each year returned 20%, which is just crazy, unheard of, especially in 1969. He also co-invented the first wearable computer to cheat on roulette. He would basically a camera, and it can count the rotations and the speed of the roulette wheel and be able to figure out like what it's going to land on. I don't know if he actually ever used it, but that was like, he spent a lot of time developing this thing. And he's, yeah, as I said, widely known as the grandfather of quantitative trading. Another figure that you probably have heard of is Ken Griffin. He began trading convertible bond arbitrage and stock options in his Harvard dorm room in the late 1980s. Graduated in '89 and moved to Chicago, where he ran the trading program for Glenwood Capital, turning $1 million into $1.7 million in the first year. Later on, he founded Citadel in 1990 with about $4.6 million under management, which is actually quite small for that time, and returned about 40% annually for the first 2 years at Citadel, which is also insane. He's also, the notable thing about him is his ability to scale. He was able to earn like 600 to 1.8 billion in good years over the time at Citadel. And the last figure, which is just an extremely impressive human being, is Jim Simons. He's a legendary mathematician turned hedge fund trader, often called the most successful hedge fund trader of all time. He founded Renaissance Technologies, which you might not have heard of. It's actually a very secretive, kind of close-knit hedge fund in 1978, and the Medallion Fund in 1988, which earned an average gross annual return of 62% from 1988 to 2021. So 62% each year for just about 33 years. $1 invested in 1988 would have become nearly 42,000 in 2001. So just insane rates of returns. But not only is he a hedge fund trader and mathematician, he won the Veblen, or he is a mathematician. He won the Veblen Prize for geometry and contributed to the development of string theory. He also worked with the NSA to break codes from 1964 to 1968 before he was forced to leave for speaking out against the Vietnam War. He's also done a crazy amount of other things. It's just nuts to see his experience and achievements. If you're interested in the history of stuff, I would highly recommend reading the book The Quants. I'm reading it right now. It's very interesting, and it's about mainly these three people as well as a bunch of others that kind of revolutionized Wall Street and made so much money. It's crazy. So it's really interesting. It's very secretive, but a very profitable kind of sector. One of the first things we can kind of go into, it's probably the easiest thing to understand, is arbitrage. And you may have heard this, you may not have. But arbitrage is simply looking for discounts across markets. So for example, if the price of one asset is cheaper on an exchange A than it is on exchange B, you can buy as much of that as you can on exchange A and sell it on exchange B for profit. So like price lower, you're gonna buy there, higher, you're gonna sell over there, and you can make that difference in profit. One of the big examples of arbitrage in crypto in particular is the kimchi premium. So due to high demand, the price of Bitcoin on South Korean exchanges can actually be much higher than the US or Europe. If Bitcoin is trading at 102,000 on a Korean exchange and 100,000 on the US exchange, you can take that arbitrage and essentially buy one Bitcoin for $100,000 on the US exchange, deposit that, transfer it over to the Korean exchange and sell it for 102,000, and you can profit that $2,000 per each Bitcoin. Now you might be able to do like a bunch more Bitcoin, or you can do this and then do it again and again and again until the price eventually converges. But the kimchi premium in cryptocurrency markets first appeared in 2016, according to a report by University of Calgary, actually. The findings show that between early 2016 and early 2018, the kimchi premium averaged nearly 4.8% and nearly reached 55%. So like you could buy, not at these numbers, but like let's say $100,000 worth of Bitcoin and sell it for $155,000 on this Korean exchange, which is just nuts. You can do that in, I don't know, a day. Or you can program it and do it much faster. Kimchi premium was also like one of the beginning ways that SBF made a lot of money. So he was able to kind of use that and exploit that arbitrage. I also have a kind of a drawn explanation here. So in this example, you can come to this US exchange, you buy one Bitcoin for $100,000, you transfer that over to the Korean exchange, and you can sell that at $102,000. After you have that $102,000, you can go do that again. So you transfer it back, and then you buy another Bitcoin, and you keep doing that. And as long as that price difference is there, there is a price difference there, and the fees aren't higher than that price difference, then you can make money there. I'll take a pause there, and yeah, for questions. Do you have a mic around you? We'll get you a mic, sorry. There you go. Should be good.
Yeah, is there any risk that when you transfer Bitcoin from this exchange to another exchange and the price maybe fluctuate during this?
Yeah, for sure. Yeah, so you want to make sure that like that difference has been there for a long time, I guess. Which in this case, like you have a pretty good standard of that if it's been at like 4.8% for 2 years. But you also, of course, want to be fast with that. You can also have it set up where if you have a lot of capital, let's say, you can have money sitting on both of these exchanges, and you can continuously like buy on this US exchange and accumulate BTC on this US exchange while you are selling BTC on this Korean exchange, kind of swap it over. That would allow you to take that arbitrage instantly because you can do it both on one exchange and then that transfer period. But it's less capital efficient because you would have to have more Bitcoin and USDC sitting in reserves. You also, of course, have the risk that you're using an exchange. So I don't know if that exchange is, let's say, FTX, then you could have that risk of it blowing up and then, oh, you're screwed. But relatively, the risk is quite low with this kind of trade. Any other questions before I move on? Cool. So This is kind of called spatial arbitrage. It's like you can do it in an instant, essentially, and make that. There's also another concept called statistical arbitrage, and there's a bunch of other arbitrages, but we'll talk about statistical arbitrage here. This is maybe more capital efficient, but in this example, let's say there are two similar stocks that trade very closely in price because they're in the same industry and have a similar performance. So you have stock A and stock B typically trade at a 1-to-1 price ratio. For example, they're both usually around $100. However, there's temporary divergence where stock B falls to $90 and stock A stays at $100. And in this scenario, you can think, okay, this is kind of weird. They're usually both at $100. There's maybe an arbitrage to be had here. This presents an opportunity. Since these stocks are expected to be at a 1-to-1 price ratio, the arbitrager buys stock B and sells stock A and waits for them to converge. So assuming that there's no like, this one company hasn't blown up and it's gone down because of this, and we have a lot of data that suggests that they should be trading at a 1-to-1 ratio, you can then kind of say, okay, well, they should both go back together. Maybe it doesn't go to 100, but if they're both correlated, they should come together. But what we can do in this scenario, stock A has, or stock B is kind of undervalued, we can say, and stock A is overvalued, and we can long B and short A. Shorting is just kind of selling the stock. Stock A and stock B statistically will converge at some point in time, and the arbitrager can cash out of their profits. So in this example, we can see that stock A falls to $95 and stock B rises to $95, resulting in a $5 profit per stock. So yeah, we can see that like, okay, they did come together because we have all this data that's backed it up that says, hey, these stocks, sometimes they converge, they usually come back together. If we can see that they're diverging, we can take that arbitrage and kind of bet that they're going to go back together, and we can make a profit out of that. So, and then you can do this with a lot more. So like, let's say you have $100,000 and there's enough liquidity in the book, then you could do that as well. There may be more risk with that as well for offloading, but any questions on this kind of arbitrage?
Is this like kind of like what you would look at for a stable coin in some cases too? Would this kind of, is this the same kind of situation? So like, let's say that USDT versus USDC.
Yeah.
It's the same kind of concept, except we're hoping that both of them don't converge at 95 cents.
yeah, exactly. So like, let's say there's some new chain and they just launched, they've had USDC for a long time and now USDT has come onto this exchange. And because of AMMs, they usually can mess with the price of assets. Like let's say USDT has now gone down to 90 cents. Okay, well, that's pretty easy arbitrage because you're like, USDT is not failing. Like we know from a while, like other chains, it's still trading at $1. So we can buy a bunch of USDT and wait for it to come back up, and then we can profit off that. So, yeah, exact same kind of thing. Any other questions? Cool. So there's, as I said, there's a lot more types of arbitrage as well. It's essentially just looking for opportunities in the market that aren't necessarily directional. So it's not like, oh, I'm bullish on this thing, I'm going to buy it. It's more like looking, oh, there is an actual inefficiency in the market where something's trading lower than it should be. And you can look for these in a whole lot of different places. Some of them, like in crypto, we have perpetual markets, which often have like different funding rates between exchanges, or like the exchange on, one exchange might have a different price than the other exchange. So you can long and short the same amount on each exchange and profit from the difference in funding rates. So for some clarity there, funding rates is if it's amount of money each period, so like every 8 hours usually, that one side would pay the other side. So if a funding rate may say that, okay, every 8 hours, the shorts are going to pay the longs, and this funding rate could be different on a different exchange, and you could kind of take opposing positions to hedge out your beta, is what you call it, and then you can get that funding rate paid. Another type of arbitrage could be like the price of ETH USDC is not the same as the price of WETH USDC. So you see two pools, ETH should be equal to the price of WETH, but they're different, so you can take that arbitrage opportunity as well. And then you can do like a centralized exchange arbitrage where, the on-chain price of Ethereum is not what it says on Binance or Coinbase or whatever. Okay, I can buy that right now on the decentralized exchange, and I think it should go to that price. Cool. Any other questions about arbitrage in general before we move on to the next thing? So I'll take a little, not necessarily break, but look at kind of the basis for the next section. But order books. Order books, if you're crypto native, you might not really understand how they work. So it's good to have an idea of how they operate, and I'll kind of take you through that. In crypto, we're really used to like AMMs, which is just the amount of one or two amounts of an asset in a pool, and that ratio kind of determines the price. An order book is more like people are saying how much they want to pay for something or how much they would sell something at. So it's a lot more complex and why we don't use it in a lot of on-chain exchanges. But it is a lot more efficient, and if you're trading with a lot of size, you usually want to use an order book. An AMM, you have a lot of slippage. If there's not a lot of assets in the pool, you're not going to get the best price, and you're not going to get usually you're not going to get the price that you're actually asking. You're going to get somewhere around there. So order books for trading are a lot better for the experience of the trader. But yeah, an order book is I said a list of bids and asks. So you can see here in this order book, we have like a ask for ETH at $2,001. So I have $100 worth of ETH that I will sell at the price of 2001. Or the highest bidder is saying, okay, I'll buy with my $100, I'll buy at price $19.99. So there's two ways that you can trade in an order book. There's maker and taker orders. So you can submit a taker order where you see these bids and asks on the order book, and you see one of them, and it's like, hey, yeah, I'll take that. Like, I agree, that's a good price. I'll come in and just take that. And that's a taker order, where you fill an existing order on the book. Or you can say, hey, I don't think that, like, if I'm buying ETH, let's say, in this book, and I don't want to buy it for $19.99, or sorry, I don't want to buy it for $2001. So I also want to buy it at $19.99. So I'm going to add to the book and submit my order. So there's not an existing order that I can take, but I'm going to add to the book. Is essentially what it does. And then you can see that, like, if you submit a maker order, it can't be higher than the price of the lowest ask. Otherwise, it would be a taker. So I can't just like say, hey, yeah, I'll buy at 2001, but I don't want to fill that order. That's not the way it works. You kind of have to fill that order if you're going to cross that the lowest ask threshold. Any questions about order books? Cool. There's also maker orders often have lower fees because exchanges like to have orders on the books. If there's no orders on the books, then it makes it quite difficult to trade. So exchanges will drastically reduce the price of submitting or of trading with maker, and sometimes it can even be negative. So there'll be like fee rebates. So exchanges will pay people to put these orders on the books. Then you also have the spread, which is the difference between the highest bid and the lowest ask. And this can be affected by exchange fees. Higher exchange fees can widen the spread. Lower exchange fees can tighten it, because there's essentially like on top of this order, you're going to pay fees. So I'll buy at a little bit of a lower price if the fee is going to be higher, or vice versa if her asks. And then if an exchange has like a tight spread and lots of liquidity, it's essentially a good place to trade. There's a lot of orders in the book. You can fill those, and you can get a really good price on something. So exchanges want to kind of promote that. Once again, I'll say anything about this slide. Any questions? Cool. Okay. I feel like I'm going fast, but keep going. So market making. Market making is traditionally a market maker provides liquidity to an exchange for a fee. Like I was saying in crypto, like a lot of exchanges will have negative fees for making orders. This is essentially a market making a way to pay for market makers. And their job is to quote a tight spread and keep the orders up on the book. Traditionally, market makers must stick to predefined terms when they trade. So in stock markets, it's very regulated, and market makers have to kind of outline how they're going to trade and stick to that no matter what the market conditions are. And then market makers usually make a profit on the spread. This is a quick example. I have a better example in the next slide. But if the price is steady and they have two of the best bids and asks at the book, and people are submitting taker orders, but the price is staying kind of around the same range, then they can make a profit by selling and buying in that range, kind of like an AMM with concentrated liquidity. If they fill both in short succession, they would make $2 per unit in that example. So here we go. I've simplified the prices, so they're a lot larger, but we have an order book here with the lowest ask at $2,100 and the highest bid at $1,900 and a spread of 209%. If we have starting inventory of 1,000 ETH and 1,000 USDC, and we're a market maker, we can assume that like most of these are our orders. So let's say somebody comes along and they fill this order. So we end up selling 0.48 ETH for 100 USDC. And now we have an updated inventory. So we've sold a bit of our ETH and we've made a bit of USDC profit. And then somebody else comes in and they buy, or they sell, and we buy 0.53 ETH for 100 USDC. So we have these close orders in the order book, and people are coming around and buying and selling, and the price is staying relatively the same. If we buy it, now we have an inventory of 1,000 and 0.5 ETH and 1,000 USDC. So we've made a profit of 0.5 ETH, which is about $100 in this example. And then we can just keep our orders up there. Like we didn't necessarily have to take them away when they filled. But if that happens a lot in quick succession, then you can make a lot off of that spread. Yeah. Any questions about that? Because that might be a little more. Yeah. Do you have a mic around you? Might have to hold the button on the bottom. There you go.
So, good question regarding the AMM itself. Can you tell us a little bit about what's special about the AMM? Is it part of a trading of an exchange? Is it just any participant can be an AMM? I assume it's programmatic. I assume it's not manual. Now, the question is, can I compete with an AMM, or can you kind of dive a little bit into that? Yeah,
so AMMs are usually on like decentralized exchanges. So Uniswap, if you've heard of Uniswap, that's an AMM. It's an on-chain sort of simulation of an order book. And AMMs work in the way, here, let me, here, I have this up here. So AMMs work on this price formula of X times Y equals K. So if we have ETH on the Y and USDC on the X.
This is essentially the binding curve? The
Sorry?
bonding, is this like a bonding curve?
Yes.
Of sorts?
Yeah, kind of. So in this pool, we have ETH and USDC. And so the price might be somewhere along this curve, somewhere. So when somebody comes to trade, they fill at like here. So they would get this amount of USDC for this amount of ETH. And anyone can supply ETH and USDC into that pool. And the price is dependent on the ratio of ETH to USDC. So if there's 100 USDC in the pool and 2,000 ETH in the pool, then the price of ETH is $20, essentially. But then if there's more, if somebody comes along and they put $2 into that in USDC, now there's $102 in USDC and 2,000 and something ETH. Wait, sorry, there's 1,900 and something ETH. So now the price of ETH has gone down because somebody, or like because of that sale. Yeah. Anybody can provide liquidity into this. So yes, it's kind of a permissionless system, but it's an alternative to an order book because it's much easier to calculate this in a smart contract. There's also things like Uniswap v3, where you can provide concentrated liquidity. So you can say that, hey, if the price is in this range, I'm providing a majority of my liquidity in that range. So I'm hoping that the price stays around here, and that's where I'll make more fees.
That's really interesting. That's like a straddle in options. But my question is, why would you want to be, let's say, situated in XY? You gave us a specific point on the tangent over there, but why would you want to be there? Like, why would somebody buy into that?
Like, why would you want to provide liquidity in a specific range? Yeah. So you can actually create like exotic options with this as well. Usually it's like, hey, I think ETH is going to stay around 2,000 for a while, so I'm just going to put my liquidity around there. And I'm not necessarily holding ETH, but I'm getting exposure to that, to those fees at that range. And then you could also provide it like way out here, and you have a sort of option where, oh, when it starts going down, you're kind of like short selling it, right? I would look at if you're interested in this kind of thing, I would look at Panoptic. Panoptic allows you to create exotic options on top of these kind of things. I can send it to you later too. Yeah. Yeah.
So essentially, I'm becoming an AMM at that certain point that I'm situated in.
Yeah.
Okay. And there are many participants, so that's basically how the bonding curve is built, right?
Yeah.
By liquidity.
Yeah.
Okay, by definition.
Yeah.
I have a question about market maker. What is the best condition to make money as a market maker? It's better to have like a price that stay in range or to have price?
Usually you want to keep it in a range, but you might have some mathematical model to like widen your spread if somebody comes along and throws a big order in there, right? And you see, okay, it's more volatile, so we're not going to quote as tight. It depends on how you want to market make. Like there can be, if you want to market make specifically for volatile markets, then you'll make more money when things are really volatile. In general, you make the most money when people aren't really paying attention to how they're trading, and they're just like, I'm going to throw a big taker order in here. That's when you make the most money, because after that happens, the market, or you get a lot of discounted price, because if a big taker comes in there, you have your orders up here, which are not around the true price, and then you can offload that back at the true price.
It also usually depends on your strategy, which is what Owen touched on. So some people like to run taker strategies and pick off lazy market makers, or, there's lazy market makers that just quote super wide and wait for fat fingers. So kind of just depends. Back in the day, BitMEX, Poloniex, you could just quote, like if Bitcoin was trading at 1K or whatever, you could quote at like $500 and just wait for an idiot to come by and make a lot of money. And there's still a lot of places you can do that.
Yeah. So yeah, that's like traditional market making. Also in crypto, like in my experience, market making is a lot wider of a definition. Like you're providing maker orders, but you're not like traditional market making, or unlike traditional market making, you're not like stuck to some contract that you're working with an exchange on. It's a lot more lenient, and like exchanges are just going to pay anybody that provides more volume to it. There might be like more standard contracts when you're working with the token. Like let's say some new token is coming out, and they don't want their price to just go crazy. They want somebody to market make that token. Then that might have like more of a contract like a traditional market maker. But in my experience, market making is more broad term in crypto. That's just my experience. It could be wrong there as well. But yeah, like I touched on earlier, many crypto exchanges offer fee rebates to traders who provide high volume rather than a fixed contract. Crypto market makers use a wide range of tools as well to minimize risk during that volatility or volatile periods, and then maximize risks or maximize profits during steady market conditions. But that can also be different per market maker, how they want to trade. Went over that quickly, but any other questions there?
Sorry, the microphone. Quick question regarding the liquidity. A question about liquidity. So everybody gets coins with low liquidity.
Yep.
Can you touch on that a bit? Like, where's the sweet spot, or at least let's hover around that in being, or actually trying to compete with a market maker on that tangent, or on that, on that line.
Yeah, for sure. In the next, coming up here, we'll actually take a look at like some of the opportunities that are out there. We can take a look at things like that. With those kind of stable coins, yeah, I mean, that may be a bit more of a risk because it's a new project. Like you don't know, is this going to blow up like UST? But you can still program in that risk and buy that if it's at a dip, or sell it if it's overvalued. But yeah, there's like in crypto, our next section. In crypto, it's kind of a world of opportunity. Like you go and try and do this on Wall Street, you're not going to be able to do that. In crypto, anybody can theoretically do it, right? And with crypto, there's an endless number of new exchanges, new protocols, assets, and it just makes it impossible for like one team to cover everything, which in my view, there's a ton of opportunity out there because of that. Now, not every strategy also in crypto requires a lot of capital. Like you can use things like flash loans, which were developed by Aave and allow you to borrow a ton of money as long as you pay it back within the same transaction. And that would allow you to kind of find these arbitrage opportunities, and you don't need the capital to back it up. You can just borrow that for a very, very, very small fee, which is kind of cool. And then the other thing is that like the infrastructure in crypto is quite complex. So it's difficult, but it's also nice because there is more opportunity if you're willing to put in that time and figuring out that infrastructure and knowing this system inside and out, then probably a good chance that you're one of the only people doing that. Now there are a ton of teams, market making teams, arbitrageurs out there as well. But it's just like bigger sea, right? There's more fish out there, and you can look for those niche options to be able to trade those. And yeah, like I said, there's still tough competition, but you want to look for those niche opportunities. And other like crypto section is super small, but other quant trading practice, like if you find this really interesting and you're like, oh, okay, I want to go do this, you definitely want to like, sorry, but you have to know how to program a bit. Now, the barrier to entry for that is becoming lower and lower with tools like AI. Like you can learn a lot nowadays and much easier than previous. But if you're willing to do that as well, you'd want to gather data. So let's say you see, okay, this new stablecoin, like I bet you it depegs a lot more, or like pretty frequently, and I bet you there's opportunities there. You first want to like create a bot that watches these prices and sees, okay, an opportunity came up here, it stayed for a minute, I could have gotten that. You want to like gather that data and see what's out there, and kind of just make sure that there is an opportunity there. Speed and latency are also very important, but not for everything. Like some opportunities are just sitting there and nobody's looking at it. And so if you can do it in a minute, then hey, you can still make that arbitrage trade. Now, when that trade becomes maybe more popular, people see you doing that maybe because the data's on chain, or somebody catches on, you want to be faster than them. Because once that's gone, like somebody else took it then. You want to be fast enough to be the first one to take that option. You also really want to understand the system that you're trading in. Crypto is very complex. If you worked in crypto for a while, it's nice because it's like, hey, yeah, I know how these things work. And maybe I could do the extra 10% of research to figure out how it works entirely. But you want to know what you're doing, especially when you're trading. And then you can get creative and kind of think about unique strategies. So like that stablecoin depegging thing, that's fairly unique, and especially if it's a protocol that like is very new and not many people know about it, you can be the market maker for that stablecoin, right? And then you want to keep iterating, like, okay, I'm making these trades, but hey, I know that like my time to place a trade is 30 seconds, and like somebody's probably going to come along, so I want to keep iterating on that and make sure that I'm the fastest. I've got these trades kind of on lock, and you want to continuously analyze that, like my predictions about this like this strategy are holding. Maybe things change in the market, and your strategy no longer works. You got to make sure that you can identify that and maybe adjust your strategy. And we could take a look at a couple things. First, is there any other questions about anything that I went through so far? Cool. Okay, so one of the things we can look at is perpetual funding rates. Now, I didn't like talk a whole lot about perpetuals, and I'm not going to fully explain them, but yeah, this should be big enough. Hyperliquid has a nice kind of funding breakdown, so you can look at coins and what the funding rate is on different exchanges. So if we look at Bitcoin, right now the funding rate, this is annualized funding rate. So if you were, never remember if funding rate is positive or negative, who's paying who. But sorry? Long span. Okay. So right now, if you were shorting Bitcoin for 1 year, you would get paid 10%. Now that Bitcoin might move in price, but you would get paid through that funding rate about 10.9%. But if you shorted it on Binance, you would only be getting paid 5.5%. So what you could do is you can short it on Hyperliquid and long it on Binance, and then you could make 5.45% without having that exposure to the Bitcoin price itself. So that's a nice arbitrage trade, especially if you have a lot of capital. You throw it in there. I mean, 5.45% a year, it's not crazy. It's kind of standard.
10 if you go to spot.
Sorry?
10 if you go to spot instead
Yes.
of doing.
Yeah, so you could also do a trade like if the funding rate is positive, then we can just short BTC and buy actual Bitcoin. We don't have to buy it on perps. And it would be less capital efficient because we would need that full amount of Bitcoin. We can't use leverage. But you could make 10%, which is quite nice. Also, you can see
Hot air.
Sorry, Farcoin.
Hot air.
hot air rises, and you can make a lot more doing that with Farcoin as well. So like, yeah, you could get paid 50 or 49, 50% if you're shorting on Fartcoin perps and holding Fartcoin. Is quite
How
nice.
do you hold a fart?
That's a good question. Or Launchcoin just launched today, right? I think 205%. Now, like, this isn't going to stay around, so you want to be watching it, making sure that like this is going to stay here. And it's nice to do this programmatically. Like, you can do this manually as well. It'd be pretty easy to do that. But if something's not going to stay around for a long time, then you want to make sure that you have some code that's running to do this and kind of get you out of that position so you're not up 24 hours a day watching. Yeah? Can you grab the mic first quick?
So I've always wondered this. How do you, if you're doing like spot and then perp, like long spot, short perps, how do you exit cleanly?
Yeah, so you'd want to make sure that like your size isn't crazy because you want to be able to exit that. But with something like Hyperliquid, like they have an order book exchange, so you generally see what liquidity is available in the book, and you can exit that.
You just need the like amount of capital to cover your exit on Hyperliquid, or like you got to transfer over. Or?
So sorry, what do you mean exactly? Could you explain that a bit more?
Like let's say you have like, you know, let's say you're short 10 ETH on Hyperliquid and then you're long 10 ETH on Binance.
Yeah.
Your ETH isn't actually on Hyperliquid.
Right.
You have to like you have to have enough capital, like in addition to your position shorting ETH, to repay the 10 ETH on the Hyperliquid, right? And so you're short 10K.
So so your long position, or Julian maybe.
So perps, you're buying a contract. You're not in the traditional like TradFi market. You would like borrow the actual asset to short, like how you would get like GameStop short squeeze and stuff, because you're literally borrowing, and then you can borrow more than the float and blah blah. Perps are more straightforward in that you just have like USDC collateral and you buy a contract that says you own, 10 ETH worth short with your enough, as long as you have enough margin to cover that collateral. So to close that position, you just have to essentially close it to again on the book. So as long as there's liquidity on the book, you can always close it because it's 1-to-1.
Do you have a question? Okay. Okay, yeah, so there's like, you can take a look at this chart here. I have a QR code for the slides at the end too, so you can find all these links. Another thing that's popped up recently is Hyperlend, lending protocol on Hyperliquid. They have an open source liquidator bot. So you could run this. It's pretty easy, like you don't really need to know a whole lot here. I will say that they are making this open source and giving this to everybody. So if you just take this out of the box and run it, you might not get those liquidations because there's going to be like 100 different people running that. But if you want to look into this and see, oh, okay, this code isn't optimized, so I can do this and it'll be this much faster. I can get my order in there faster. Or if I run my server in this location, it's going to get there faster and whatever. This, I believe it doesn't require any capital other than deploying the contract. But you could like deploy this, maybe you get a big liquidation and you just have some more money there. Be nice, but,
Yeah, so in terms of speed,
yeah.
what I noticed, not only specifically on all these AMMs, but in other places, basically you want that speed to have that edge, and it's either you pay more money for some sort of RPC,
Yeah.
or you buy hardware, or I mean, you need to expend somehow to get that edge. Or am I wrong here?
So
Like out of the box, things are not just gonna. You're not gonna get that kind of APY.
yeah, so it depends. Like, I mean, so the ones that we looked at out of the box, yeah, you could get that. Like those are kind of sitting there, and those I believe if it's I don't know how Hyperliquid does that on the UI, but I had it set for a year term. I don't know what that's based on, what look back period that is. But I believe Fartcoin has been, I think it's average of 12% funding or annualized. But like over history, I was looking at it last week, and I think it was like average of 10-20%
Okay.
for the last like 3 months. That kind of thing, like you don't really, latency doesn't matter. For this kind of thing, like, yeah, you might want to be faster because it's it's an opportunity that'll only be there for a second or microsecond.
Is there a scenario that you can get stuck with one leg, or is it one contract that has both legs in it, like both positions?
Yeah, no, I mean, theoretically you could, but with what we looked at previously, like, there are a lot of venues to trade that on, and a lot of like large venues, so you wouldn't necessarily be stuck there. But yeah, I mean, there's always those risks and things to look for sure. Yeah. Yeah. And then one more. Oh, a couple questions. Yeah. Okay. Do you have a mic over there?
One of the questions I had about is MEV.
Yes.
How much of a risk is that to all of these strategies?
Yeah, so you want to be careful as well. Usually you can, so if you factor that in, usually somebody could take that trade before you using better MEV strategies. As long as you don't have like crazy slippage set, then you're generally protected from like MEV attacks. Now, right, if you go and do this on mainnet where like MEV is just a shit show and everything's owned by a few people, then you're gonna have a very hard time making these trades. But I like to think about it in like the sense of, hey, there's this new chain that like nobody's really figured out yet. I'm gonna go for that angle, try and figure that out, and then I can kind of be the king of that chain. But yeah, generally like MEV, if you're factoring that in, the worst it can do is like take that trade before you. If you're pretty reckless, then you could get attacked by that. But yeah, that would be my take on it. Cool. And then one more tool is just DeFi Llama. I like it because like if I was looking for an opportunity or an arbitrage, I can just go through all these different protocols. I can see like, let's see, top protocols. I can see, okay, on Gnosis chain, there's these derivatives, Contango. I mean, it's got 34 million TVL. It's not a huge exchange, but there's probably nobody like looking for arbitrage opportunities there, or like not a whole lot of people looking for arbitrage opportunities there. So if I'm willing to put in the work, hey, maybe I can actually make a decent amount off of that. Oh, that was just derivatives in general. But yeah, I don't know. DeFi Llama is just a really interesting tool to look for these kind of things. See rising protocols. If I'm the first one on this protocol that ends up being really good and I have the inside knowledge of how this thing works, I've been trading on it for a while already, then sweet. Like more people come in and trade, there's more opportunities for me, and I can do it with more volume. But yeah, that's just another tool that's pretty cool. Oh, it's not on. Sorry. Hold the button on the bottom. The silver button.
I have more specific question on an Hyperliquid.
Yep.
But like there is several over collateralized stablecoin, CDP, like yeah, and they have like a huge spread around $1, and it stay for a really long time. So why nobody taking this opportunity? Is like maybe because it's risk of this protocol. So
That could be risk, or it could be that just nobody's looking at it. So you could go take that.
You'd be surprised the amount of time the market's just inefficient.
Yeah. Any other questions? Cool. Well, thank you guys. Yeah, if you wanted to find any of those links or look through those slides again, I believe this QR code links here. It should. I set it up to. Let me double check. But yeah, this should take you to scam. Yeah. Go. Don't enter your seed phrase. Yeah. There. Yeah. Thank you.
Did you draw the?
No, Midjourney.
Oh.
So I found this Midjourney SREF, and they have, if you've used Midjourney before, it's a really nice tool to create AI imagery, and they have this, or there is this third-party website that has a bunch of style references. So you can use these style references just as a parameter when you generate your images, and it'll come out as that style. Really cool. So I found like a, how do I see my saved ones? I think it was this one. Yeah. 894157069. Cool. Yeah, thanks.
All right. Any other last questions? Going once. Going twice. All right. Sweet. Thank you very much, Owen. Thanks, everybody, for coming out. And if you don't mind, if you can fold up your chairs and we'll just stack them up behind the door, would be amazing. And yeah, feel free to stick around here for a minute or two. And yeah, before the music starts upstairs. Okay, thanks, everybody. See you. And next Thursday. Next Thursday, where are we going?
Pizza.
Pizza Dow. So we'll see you all next Thursday.